네, 한글마 구독자 여러분 안녕하세요. 참 어느 때보다 주식하기가 어려운 시기입니다. 은행의 위기들이 불씨는 여전히 꺼지지가 않았고 연준의 금리 인상 경로도 가늠하기가 쉽지 않습니다. 이렇게 변동성이 커진 상황에서 우리 투자자분들 어떤 점을 유의하셔야 할지, 앞으로의 시장 전망은 또 어떤지 리처드번스타인의 댄 스즈키 차석 최고 투자 책임자와 함께 시장 전망에 대해서 이야기를 나눠보려고 합니다. Hi, Dan.
Hi, how are you?
Great, thank you. It's been a while since we had interview last fall. A lot has happened since then. Inflation remains high and the recession seems to be on the horizon. The issues have emerged at some banks, such as Credit Suisse and Silicon Valley Bank, leading to a sense of crisis in the financial industry. Investors are now expecting a market downturn and worrying about their investment strategies. So let's begin the interview today and hoping that you can provide some valuable advice. Okay, so
Great.
this is the first question. With the growing crisis in the banking sector, the market is becoming anxious about the possibility of a financial crisis. Following the latest FOMC meeting, there seems to be even more confusion. How would you assess the outcome of the recent FOMC meeting?
Yeah, I think, we don't spend a lot of time arguing about what the Federal Reserve should do because we're more focused about what they're actually going to do. And that's a much more important driver of markets. So putting my opinion on whether they were right or wrong, I think everything they did is to be completely expected, because I think one of the things that got them into trouble in the first place was relying on forecasts which weren't very good. I mean, this whole period where inflation was picking up and they kept using the word transitory over and over because they forecast inflation to come down, that got them into a lot of trouble. So I think they've tried to exit the forecasting business and are more focused on reacting to the policy that they're seeing on the ground. And I think when you look at it from that perspective, they've done a tremendous amount of tightening, and they are seeing signs of slowing in the economy, and they are seeing signs of slowing of inflation. And so from that vantage point, it makes sense that they would already begin to signal that they're going to be slowing down the pace of hiking. And then we had, the events with the issues with the banks. And if you think about the whole mechanism with which the central bank affects change, they're trying to curb lending. And so based on what you've seen in the banking industry, you're already going to see probably a substantial slowing of lending in response to the issues at the banks. And so from that vantage point, the issues have actually done some of the Fed's work for them. So they don't need to hike as aggressively. And clearly, when you're seeing, more and more concerns around banks failing, then you have to have some concerns around financial stability, which is another of the Fed's sort of underlying goals. And so I think, whether it's right or wrong, I think remains to be seen. But I think the reality is this is exactly what you should expect from a Fed, given its mandate and given, the way it's enacted policy over the last, few years.
Okay, thank you. And also, we remember that the Powell said they don't see the rate cut this year at this point. But despite Jerome Powell's statements that he has no plan to rate cut this year, a treasury yield in the market do not seem to reflect this sentiment. So how do you view the possibility of the rate cut in the near future?
I think there's a reasonable probability that the Fed cuts rates by the end of the year, but it's far from a certainty. Ultimately, I think what's going to determine, the trajectory of policy, whether they raise rates more, or they start cutting rates, it's ultimately going to come down to growth. If you think that growth is going to accelerate from here, you're probably going to see more hikes. But if you think growth is going to fall off a cliff, you're probably going to see more cuts by the end of the year. I think you mentioned that the market is pricing in some pretty aggressive cuts later this year. I think that to me seems a little bit aggressive. If they are going to cut, basically what the market's pricing in is that the economy is going to collapse, within the next several months. And while that may happen, it just seems like it's a lot harder for the economy just to move that fast given its size. So if you are going to see it really start to slow, it's probably not going to be, in a meaningful way toward the latter part of the year. So it's hard to imagine the magnitude and number of cuts that the market's pricing in. That just seems a little bit aggressive to us.
Yes. And before we move on, I just have one more question about this topic. The gap between long and short-term treasury yields narrowed these days. They are coming down from their peak, the treasury yield. So what is your outlook on the future treasury market, and what is your view on investing in bond market?
Yeah, so I think, you have to recall where we came from. Based on the Fed's policy over the last year or so, you've seen a historic inversion of the yield curve, meaning that, 2-year interest rates, treasury interest rates were much, much higher than 10-year. Typically people have been focused on that as an indicator of a recession. But more importantly, it's an indicator of liquidity. What that's telling you is if you think about the two parts of the yield curve, short-term rates are really just a measure of where Fed policy is today and where it's going in the near term. The long end of the curve is really a measure of market's expectation for long-term growth and long-term inflation. And so when the yield curve is as inverted as it was, that's telling you that market policy is very, very tight, relative to where those longer term growth expectations. And that's by design, because the Fed is literally trying to tighten policy and slow down the economy. So that's to be expected now with the recent bearishness that's kind of hit bond markets. You've seen, that yield curve start to go the other way, meaning short rate expectations are coming down because they think the Fed is going to cut, which is what we just discussed. I think, the biggest opportunity within the treasury market is actually owning the long end of the curve, owning longer term treasuries, because if we're right and that growth is going to continue to slow from here, that's probably going to be the bigger driver of interest rates, and that's probably going to push interest rates lower. That's what you've seen in this part of every single cycle historically. So I don't think that this time will be any different. So I think that's the biggest opportunity. I think people want to own duration here, which is the exact opposite of what you wanted to do last year.
Thank you for advice. So now I'd like to ask about the banking problem. The recent banking crisis is a major concern for investors. So how do you perceive the banking issues, and what's your prediction for its future development?
Yeah, I think, the specific timing and the way these events unfolded, caught the markets off guard. But I think it's important to recognize that, these types of events are the natural consequence of what happens when the Fed's tightening policy. That's the whole point. People often forget that, the Federal Reserve is also called the central bank, and people forget the bank part of that title. The way they affect change and the way they get banks to curb lending is not to politely ask banks to make less loans. It's to actually make it less attractive and less profitable for banks to make those loans. And when you make loans less profitable and you tighten liquidity and reduce the amount of money in the economy, the natural consequence is the lower quality and riskier banks are going to struggle. Their businesses are going to struggle. And that's exactly what you've seen. And so I think that's the issue, whether I think the Federal Reserve and the regulators in general have done enough to contain the crisis such that, these events aren't going to single-handedly collapse the economy, but there are still ongoing headwinds, regardless of, whether or not, there's a huge crisis as a result of one or two banks failing.
But also there is a trend in the market to buy banking stock when they dip, as known as buy the dip. So what are your thoughts on investing in financial stocks at this point? And what advice would you give for investors who wants to invest in banking stock?
Yeah, I think the answer to that question is really a function of your time horizon. I think you got to think, very, very short term, next few weeks, medium term, next to 6 to 12 months, and then longer term, next 6 to 12 years, let's say. I think in the very near term, over the next few weeks, who knows? There could be a trade in there. Oftentimes things get oversold too fast and they get a rebound. And that doesn't really, so there may be a bit of a short-term trading opportunity. When you think about it from that medium-term horizon, though, I think this is just not the time in the cycle where you want to own financials. If you think about it, again, the whole point of what the Fed is trying to do is continuing to make it more difficult for the banks to operate. So their loans are going to be less profitable. They're going to be making less loans. They're going to see more people and businesses default on their loans, none of which are very good for the banking industry overall. So this is just not the time to own them. The time to own them would be when the recovery is actually in its early stages. That'll be a great time to own them, but we're not there yet. But for the long term, that 6 to 12 month time horizon, I think the fact that no one wants to own these stocks, that they've underperformed for a while now, I think that's the opportunity. It's a cheap out of favor area. And there's no reason to say that the long-term fundamentals are going to be poor simply because they're challenged today. And so I think I actually am quite positive on the longer-term outlook. So if you invest in them today, you'll probably eventually do okay, but you'll probably get a better buying opportunity, later on in the cycle.
So do you concern about any specific banking stock which could occur a big problem like Credit Suisse or Silicon Valley Bank?
Yeah, well, we're not really stock-specific analysts. I think in order to answer that question, you need to be doing the real work and digging through their balance sheets and their assets and really understanding the ins and outs of what they own and how much they're worth. That's not where we spend our time. But I will say, when you're in the point in the cycle where things are slowing down, and it's actually a rare combination where things are slowing down and the central bank is still tightening, trying to slow it even more, that is a recipe for the riskier and lower quality, whether it's countries or companies to struggle. So I don't doubt that this is probably not the last, big failure or crisis you'll hear about. But I don't know which company that's actually going to affect.
Okay, thank you for the answers. And now let's talk about the economy. Some people are predicting a hard landing, while others foresees a soft landing. When and to what extent do you anticipate the onset of a recession, and why?
Well, first of all, I think from a stock market perspective, whether or not we see an economic recession is always going to be secondary to whether or not we're going to see a corporate profits recession. When you invest in the stock market, you're not buying GDP, you're not buying the economy. What you are doing is you're investing in corporate profits. That's why corporate profits recessions are much more important. And when you look at the environment we're in right now, whether or not there is some debate about whether or not we'll eventually be in an economic recession, but there is no debate about whether we're going to be in a corporate profits recession because we already are. And so I think that is the big issue. There are big differences when you compare the composition of corporate profits in the economy. And when you look at the economy, it has much more supports than corporate profits do. That's why, GDP right now for the first quarter in the US is tracking around 3%, despite the fact that corporate profit growth is negative. The reason for that is the economy is much more geared toward households and household consumption. And when you look at that part of the economy, we have, one of the tightest job markets, labor markets in 50 years. We have gas prices that have been coming down. We have quite strong balance sheets, and now mortgage rates have actually started to come down as well. So there are more supports for the economy than there are for corporate profits, which don't have as much of that consumer and household exposure, which is why they're in a profits recession today. So to answer your question, will we eventually be in an economic recession? The first answer is it doesn't really matter as much. But secondarily, I think that we probably will be because we're already seeing, this slowdown in growth, and the Federal Reserve is actually trying to, make that slowdown even worse. In fact, when you listen to the words that the Federal Reserve is using, they'll say there's a narrow window for a soft landing. But by definition, what that means is it's more likely than not that we're going to go into recession. And so if you have a Federal Reserve that's slowing the economy and believes that there's a high likelihood of a recession and is okay with that, then the risk of recession is certainly very high.
Like you said, we can see the slowdown of economic cycle. But despite the poor economic outlook, inflation remains high and the labor market is still tight. So how do you analyze the current employment condition and inflation expectation?
Right. Well, if you look at the inflation environment today, it started with the leading and volatile components like goods and commodities. That's where it started. A lot of that was exacerbated by the supply chain issues during the pandemic. A lot of those sources of inflation have really gone away. They're not really adding a lot to inflation today. What is adding to inflation is the services side, which is basically a function of shelter and housing, how much you're paying for where you live. And then the second is services. If you look at, there's a big discrepancy between, the housing related data going into the CPI versus the real-time indicators. So that, what we've seen is the real-time indicators suggest, that rent prices and home prices are coming down. So there's some optimism that that component of inflation is actually going away as well. So then the last part of the equation that people have concerns about is really the non-housing services side. That's where there's tremendous demand, and a lot of what's driving that is people's desire to travel, spend on entertainment, and like that goes back to the issue of very strong, a very tight labor market and very strong household balance sheets. I don't think that that'll last forever. So I do think that as growth slows, that inflation will come down, but that's a sticky, more lagging component. So it'll probably take some time for that to come down. On the labor market side, I think it is clear that the labor market's slowing. I mean, I don't think there's any major metric of the job market that isn't well off its peak in terms of growth and rate of change, but it's very, very slow. And the reason for that is, again, this is one of the tightest labor markets in over 50 years. And so there's just this big mismatch between the amount of available jobs out there and people looking for jobs. And so until those get closer together, there's more cushion to absorb some of the slowdown in job demand. So I think, things are slowing, but it's hard to imagine that they're going to really collapse in the next few months. It's probably going to be a slower, drawn out process for the labor market to open up. But you are seeing those clear signs that is happening.
Thank you. And now let's talk more about the investment side. So I remember that in last interview, you expressed a sort of negative sentiments about the technology stock. However, some Wall Street analysts believe that these stocks may be promising if an economic recession occurs. What is your current view on investing in technology stock?
Yeah, I think that sentiment that you just referred to, that alone keeps me quite cautious on the technology sector, because that tells me, people don't realize, the risks associated with the sector, and people really haven't capitulated. As bad of a year as last year was, people are still very, very optimistic about, the resiliency of these companies and their profits. But if you think about, technology profits, outside of a COVID or a pandemic recession, their profits are extremely economically sensitive. And so what happens is, if we're right in that growth is going to continue to slow, their profits growth is probably going to slow as much, if not more, than the rest of the economy and the rest of the market. Why is that? Well, as things slow, consumers' ability to buy all these technology services is going to decrease. People have a lot of technology subscriptions, whether it's streaming media or food delivery or what have you. People are going to tighten up their belts and consume less, and that's going to reduce the growth, especially when you're talking about, phones that cost over $1,000, cars that cost over $50,000 or $100,000. These are very, very expensive items. And so they're the natural thing that you probably will slow your purchases on as things start to slow. But it's not just the consumer side, it's also the business side. You're already seeing layoffs start to pick up. Well, when you lay off workers, you need less software licenses, you need less hardware equipment. And so this is just normal economic activity during a slowdown. So I think the big risk, though, is that as you alluded to, people are really that's not in people's expectations, despite the fact that if you look at the slowdown we've already seen, these companies' earnings have already slowed down the most. I mean, most of the industries and sectors associated with technology and technology-related areas are seeing their earnings down double digits already. And we haven't even really seen a meaningful slowdown in the economy. So I think that is the risk. And meanwhile, the market is heavily concentrated in these stocks. They're still the most expensive, part of the market. And they were the biggest beneficiary of the record liquidity in the markets and the economy over the last few years. Well, clearly that liquidity is going the other direction. That liquidity is tightening, and that's probably going to hurt these stocks and these companies on the other side. So for those reasons, we're still quite cautious. If not for just the idea that bear markets or market crashes always signal a change in leadership. You can argue whether or not the bear market's over, but we've had the signal, so we already know that these types of stocks are not going to be the leadership of the next cycle as well.
Yeah, so you're still cautious about the tech stock. And actually, there is one more, the popular theme in tech stock. The AI is really popular in these days, the ChatGPT-driven AI boom. So like NVIDIA. So could you tell us your opinion on AI stock as well?
Yeah, I think the important word in that question is you said AI stock, right? You didn't say AI, the technology. And that's where investors need to separate, the story from the investment. If you think about the last, tech bubble, the internet bubble that we had in 2000, there was a very big difference between the internet as an investment versus the internet as a story. Internet as a story, blew away any expectations. Whatever the promises of the internet bubble were, they came true and then some, because if you think back to early 2000, our usage of internet was very primitive. We were using AOL online dial-up, and we weren't doing a lot of online shopping or internet surfing back then. And so it was really in that period where tech was a laggard from an investment standpoint, where internet technologies were really changing our lives. In fact, if you bought internet stocks at the peak of 2000, it took you basically 14 years to make your money back. And I think there's going to be a similar story today with respect to AI. AI as a technology has massive applications for all different parts of our lives and how businesses operate, but that doesn't necessarily mean that these are going to be great investments. As you've seen, many different companies are spending a lot of money in this technology. Who's to say, which is that they're all going to benefit equally? So if you go buy a basket of AI-driven stocks, chances are a lot of those are actually going to be failed investments from the AI side. Some will probably do well, but some will not. And so people are probably right now overpaying for the potential or the hope or the dream that all of these companies will do really well and be beneficiaries of AI. But history suggests that's probably not going to be the case.
Let's talk about the overall market. Moving back to Fed decision, if the interest rate remains unchanged or are cut soon, how do you think the overall stock market will respond?
Well, I hate to be a broken record, but I think it depends on your time horizon. The immediate market reaction from a surprise easier Fed policy is always generally going to be positive, right? So, the day that you see the surprise and the Fed cuts interest rates, the market's going to have a positive reaction, maybe even the week or 2 weeks following it. But I think, two things to keep in mind. First, you have to remember why they're pausing. They are pausing because a lot of their work is being done and growth is slowing, and we may be going into recession. If that's the reason that they're pausing or cutting, that's certainly not a good reason to invest in the stock market. And I think that ultimately, the big driver of Fed policy is going to be growth. And so, if growth slows, we may cease to have an inflation and a Fed policy problem for markets, but you're going to have an even bigger earnings problem. And so I would say that presents not a great risk reward for markets in that type of slowing growth environment.
Yeah, so it's really hard to make a portfolio in this market. So some of our viewers asking about what is good portfolio at this point. So I want to ask you that how should investors make their portfolio during a recession, and which industries do you think promising in those situations?
Well, other than the obvious answer, which is to invest, partner with us in their investments, I think, from a high level, when you're going into recession, if we're going into recession, the way you want to position for that is to own the companies that are going to have the most stable profits, whose profits are going to decline the most, or in a good scenario, they're actually going to see their profits accelerate. Any of those companies and industries made up of those companies should do very well. And so if you think about, if we go into a significant slowdown, what types of companies, what kind of companies see their profits hold up the most? Well, you see basically a transition from, the spending and profits focused on the wants, moving toward the needs. So the discretionary moves to the necessities. And so if you think about the traditional necessities out there, from a sector perspective, that would suggest healthcare, staples, and utilities. Why? Because no matter what the economy is doing, if you get sick, you're still going to have to go to the hospital, still going to have to buy medicine. No matter what the economy is doing, you're still going to have to heat your home. And no matter what the economy is doing, hopefully you're going to have enough money to put food on the table and buy toilet paper and toothpaste and things like that. And so these are the types of companies that make and produce those goods and services.
So it was the advice for the case of recession, but what if there's no recession or soft landing? Then what would be the good portfolio for the investors?
Yeah, you want to do the exact opposite,
Yeah.
right? If we see a reacceleration in growth here, then you're going to want to buy, the most cyclical sectors. And so if you think about traditional economically sensitive sectors, that's financials, as we talked about before, energy, industrials, materials, and technology stocks potentially, in that environment, those will be all, and consumer discretionary stocks, those will all be big beneficiaries of a big pickup in growth. And so in general, that is the time in the market when you want to actually own lower quality investments, lower quality companies, smaller companies, higher beta companies, and within, the credit side of the world, more junk and high yield type of companies, you're going to be rewarded for that risk if growth is actually accelerating.
Okay, thank you. So it depends on how economy is going on from now. So let's talk about abroad. The tension between the United States and China is escalating. And although China has begun reopening, the effects are not clear yet. So what is your outlook for China, and how do you anticipate this will impact on the market?
Yeah, the outlook for China, I think, is very, very positive. You can't find a region in the world that looks more different in a good way than everywhere else. I mean, at RBA, we always look at things through the lens of corporate profits, liquidity, and sentiment. Those are the three things that drive markets. And when you look at it from that perspective, you have the rest of the world that's going into a profits recession, and you have China that's been in a profits recession that's actually showing recovery and is likely to exit that profits recession, very soon. From a liquidity standpoint, we talked about the Federal Reserve, but central banks all over the world are raising interest rates to tighten liquidity. In China, they're lowering interest rates. They just recently cut the required reserve ratio, and they're inducing, their banks, many of which are state-owned banks, to actually increase their lending. So you're seeing credit growth pick up. And then the last, pillar of our process is to look at sentiment. Clearly, the U.S. is probably the most expensive major market in the world, whereas China is trading, not quite at a half multiple, but a much cheaper valuation than the U.S. because people are more concerned than the geopolitical risks and the political risks than they are those actual fundamentals that drive markets. And so that's a great combination of factors: accelerating profits, improving liquidity, yet everybody's scared to invest. So that's why we think China is a great investment here.
And I want to talk about the other countries which looks optimistic from now. So are there any continents or countries or regions beyond the United States? Why do you think about that? I want to just find somewhere to invest.
Well, I think if you were to rank, all the major countries and regions of the world, right now, from a fundamental perspective, China would probably be the best, and the U.S. would probably be the worst. And that's because of those profits, liquidity, and sentiment dynamics that I mentioned before. So everything in between, most countries in the world or most regions of the world look probably more attractive than the U.S. from a risk reward standpoint, but most regions of the world are seeing deteriorating fundamentals, i.e. profits are slowing outside, with the exception of China. Most regions are seeing a slowdown in profits growth. Most regions are seeing a tightening of the liquidity. So there's no region that sticks out as being amazing, over the course of the rest of this year, with the exception of China. That being said, I think that Japan and Europe present some interesting risk rewards here. With respect to Japan, it's very cheap and out of favor, having underperformed for many, many decades now. It has a set of high quality companies with strong balance sheets, and it also tends to benefit from the safety trade within the yen. So I think that Japan is kind of a low beta place to get cheap and high quality stocks in the world. And then Europe is somewhat similar, but it's important to keep in mind that, at least comparison to the US, its earnings and profit trends are much, much more resilient, at least so far. So you get actually cheaper valuations and superior profit fundamentals. I think that makes for a better dynamic than what you're seeing in the US today.
Thank you for answers. And this would be the last question. Actually, the Silicon Valley Bank problem and the Credit Suisse banking crisis was kind of black swan, which we didn't expect it. Do you see any remaining black swan or substantial risk at this point?
Yeah, I think black swan is probably a term that gets used too many. If we have black swans every year, then they're probably not black swans, right? But I think that underneath your question is really, are there any hidden, unrecognized systemic risks out there? And as I alluded to before, there are bound to be some. I mean, when growth is slowing and liquidity is aggressively tightening, that's when you see some of the lower quality companies and countries, run into trouble. And that's when you start to identify, these troubled bank balance sheets and things like that. So again, I'm not combing through the thousands of different companies' balance sheets to understand where those risks lie, but I would not be surprised, to see more of them occur even, later this year. And so that's all the more reason why I think it makes sense to be focused on higher quality companies, higher quality countries, and more defensive profits and cash flow streams. I mean, those are the parts of the market that are going to protect you from wherever those black swans occur. You'll be somewhat shielded and protected.
Great. And that was my last question. And is there any other advice that you want to give to our viewers? For example, do or don't at this point?
Well, I think the most important thing is, despite all the volatility we've seen over the past year, is don't give up on your plan. If you think about the financial crisis, which is the last huge market crash that we had, the thing that got investors into trouble was not the fact that we had the market crash. It was the fact that people responded to the market crash by selling out of their risk exposure in their portfolio. You need to stick to your plan. And actually, when you do that, market crashes can actually be the best thing that can happen to your portfolio. So long as you're still contributing and still investing, a market that crashes is actually much better for your future wealth than a market that goes up 10% a year. And so that's the most important thing, is when you look at it from that vantage point of the long-term strategy and the long-term plan, I think the fact that, market valuations in most regions of the world and most sectors of the world have gotten very, very attractive, I think that should make you very excited about the long-term returns you're going to get over the next 10 or 15 years. I think you'll be surprised at how attractive those returns will be.
So stick to our plan. It was great advice. And thank you for your time in this volatile market. We trust that investor will listen to your advice and make better choice. So we look forward to seeing you again in the next interview. Thank you, Dan.
Thanks for having me. Thank you.